people turning 65 right now, there's a 70% chance they will need some form of extended care in their lifetime. I had a mentor once tell me that the average American worker will work 90,000 hours in their career, and that's a sacrifice. When you're away from your family, you're making a sacrifice so that you can be at work and provide for your family. And the average cost of nursing home across the country is about $9,000 a month, which is over $100,000 a year. So if you've got anyone with any kind of wealth put together and they go into a home, you can see how that could really put a drain on their portfolio in a hurry. So if you haven't planned for it, it can really derail you.
Welcome to Metcalf Money Moment, the podcast. Unlock financial clarity and confidence with expert insights to achieve your goals. Hosted by Jeb Graham, Ethan Hutchison, and Eric Wymore. Each episode offers decades of combined expertise in wealth management, retirement planning, and more. Join us for practical strategies to inspire your financial journey. Now your hosts.
Welcome to Metcalf Money Moment podcast. My name is Jeb Graham, here with Ethan Hutchison and Eric Wymore. Today we have a very special guest, Aaron Clark, who, Aaron, we've known each other for a very long time. Basically, I think it was probably 2012 when we first met, when I had just kind of moved over to the independent side, and you and Eric and Ethan and us have worked together for a long time. You were with OCI Insurance, which is what would you call it, Aaron? Is it an FMO?
Yeah, I mean, the industry knows it as an FMO. Basically, we're an insurance brokerage company.
Okay. Yeah. So I thought today maybe we could start out with, if you want to talk a little bit about OCI, if you think that's important. And then, from our client standpoint, I know we've had conversations about different insurances, specifically long-term care insurance, which is a conversation that we have with a lot of clients. And it's a worry when we're building financial plans. A lot of times we're like, hey, there's one thing that can take this financial plan down, and there's only one thing, and that's if you end up going to a nursing facility for a very long time. So I think maybe we can talk a little bit about that risk, as well as some other risk management stuff as well.
Sure. Yeah. So OCI, so we are an insurance brokerage firm, and basically we can handle any kind of insurance other than property and casualty. So I actually learned recently, I think we even do like trip insurance. But the department that I work in with OCI typically deals with life insurance, annuities, long-term care, risk management in those areas. And you're right, Jeb, long-term care, it's a very important topic right now, and it can derail a financial plan if it's not prepared for. LIMRA did a study a handful of years ago that said people turning 65 right now, there's a 70% chance they will need some form of extended care in their lifetime. So that means you take 10 people and put them in a room, there's a great chance that seven of those folks are going to need some form of extended care in their lifetime. So if you haven't planned for it, it can really derail you. And, what we found, we talked earlier a little bit ago about, I had a mentor once tell me that the average American worker will work 90,000 hours in their career. And that's a long time. I know that a lot of times you guys, get to work before 8, sometimes they're after 5, sometimes work on the weekends and in the evenings. And, to me, when those things are happening, that's a sacrifice. When you're away from your family, you're making a sacrifice so that you can be at work and provide for your family. Well, I'm pretty sure that if you ask people that are retired, if they worked 90,000 hours and made all those sacrifices during their career so they could give that money to a nursing home, I'm pretty sure they would say no. And so if we can, plan for it, it is potentially going to happen at some point. The costs are very real. I've got my wife has a stepdad and a dad. And so I'm blessed with 2 father-in-laws, and both of them are in assisted living or a nursing home right now. And the average cost of a nursing home across the country is about $9,000 a month, which is over $100,000 a year. So if you've got anyone with any kind of wealth put together and they go into a home, you can see how that could really put a drain on their portfolio in a hurry.
For sure.
And Aaron, that 9,000 number you mentioned, that's just average. I mean, if you get into, memory care and some of the more higher touch things, can it get up to, 15,000 in some cases?
It can. I actually was visiting with someone in Washington State recently, and they were asking me for a quote for long-term care insurance, and they wanted me to price it at $11,000 a month, just because of cost of living in certain areas. California, for example, New York, places where cost of living might be higher than they are in the Midwest. Certainly, they can be north of $10,000 a month.
So I'll tell you, Aaron, like for us as financial advisors, when we're working with clients, and I'm going to be just totally honest, and I'm sure Ethan and Eric would agree with this, is that it's always the least fun thing to talk about, right? Because when we're working with a client and we're planning their retirement and we're talking about all the vacations that they're going to take, all the freedom that they're going to have in retirement, maybe the second home that they're going to buy. That's the exciting stuff, right? As they're getting ready to retire. And then as they retire and kind of move on, I feel like that's really when people start to think about, well, I want my kids to inherit X amount of money or whatever it is. And then you kind of, and not that we don't bring up long-term care in the beginning, we do, but it's typically not the very first thing that people start thinking about when they think about their retirement. It's also the thing that can derail their estate more than anything. But I guess from your perspective, like when do you think that people should start thinking about it? When is the prime time to get long-term care insurance, and when is it too late?
That's a great question. So I've been having conversations recently with folks, and if you were to ask me when's the optimal time to buy it, I would say 50s, mid 50s. I had a lady come to me recently she was 39 years old, and she asked me for long-term care insurance, and my response to her was, "What happened?" And she said, "What do you mean, what happened?" I said, "People that are 39 don't buy long-term care insurance. So what happened in your family in order to make you start looking for it?" She said, "Oh, I understand the question now." And she was married. It was her first marriage, but it was her husband's second marriage. And they're currently, his 90-year-old dad was living with them. And so her reason for wanting to look at long-term care insurance was she said, "I don't want to be in that position when I'm that age.
Yep.
I want to be responsible. I want to plan for this so I don't have to have my family taking care of me and so forth." I'm a big believer in protecting your insurability. I grew up as a life insurance agent, right? And buying life insurance is important to do when you're young and when you're healthy, right? And so always protecting your insurability is key. But do we want to buy long-term care insurance when we're 30 years old for something we know we're not going to use until potentially 70 or 80 or later?
If you
I
ever
mean,
use
life
it, right?
insurance, no one
Yeah.
has a lease on life.
Yep.
So we don't know when we're going to die, right?
Mm-hmm.
And with long-term care insurance, we don't have a crystal ball. We don't know, but we certainly want to plan for it. So when's the optimal time? 50s, early 60s. It's expensive to begin with, but it starts getting even more and more expensive, when you start hitting 70, and then of course by the time you're 78 or 80, you can't buy it anymore. It's the insurance companies are like, "You've worn out your welcome. We don't want you anymore. You're too close to needing to have that." And quite honestly, it gets very, very cost prohibitive for anybody
Yep.
when you're in your 70s.
Yep.
Well, I think that every once in a while the conversations we have and the reluctance is the cost, right? And understanding that, hey, you're going to spend quite a bit of money on this policy, and hopefully maybe you don't use it. Is there any kind of conversations that you have with individuals that have to continue to pay a long-term care insurance but maybe not use it? Are there any features that could be used inside a policy that kind of combats that reluctance?
Yeah, so the peace of mind, when I got into long-term care insurance, I started in the industry in about 2001. And I'll never forget my agency manager. We had a long-term care policy. He said, "Aaron, I want you to champion this. I want you to master it and go out and talk to our clients about this. Help them understand the importance of this." And so I'd go out and meet with folks. And the biggest objections I would get when I would talk to customers is, "It's expensive. And what if I never use it?" Well, LIMRA is telling us that there's a 70% you're going to use it, right? But what about the 30% that don't? Long-term care insurance, if you're spending $5,000 or $10,000 a year or more on a premium for something you may never use, that's kind of hard to stomach that, right?
Mm-hmm.
Well, the good news is the industry, I don't know how long they've been out, at least 15 or 20 years, so that's how long I've been talking about them. But the industry came out with what's called a hybrid policy. And so those are not use it or lose it. So the benefit of a long-term care hybrid policy or asset-based insurance is the fact that if you don't use it for care, whatever your long-term care pool was at some point will blossom and turn into a death benefit and pass to your heirs. So the peace of mind there is no matter what happens, whether you live, die, go into a nursing home, need home health care, whatever the case may be, 100% of your policy benefits will pay out to someone at some point in time. So the peace of mind is, look, I know I'm spending a lot of money on this thing, but at least someone's going to benefit from it at some point. Mm-hmm. In addition to that, a lot of these hybrids have what's called it's not necessarily return of premium, but it does have a residual cash value in them at some point. So if someone did want to bail out, there is an exit strategy. I can't imagine this scenario happening, but if someone bought a policy and 10 years from now, they said, "You know what? I don't want this. I don't need this. I was crazy for buying it," whatever the case may be, it's going to be really hard to walk away from a policy that you put, $10,000 a year in for 10 years, right? But if there's a cash value or an exit strategy, if you have to bail out, it might make it less painful to leave in the event you decide to do that. But again, when people buy policies, they generally buy them to keep them. They don't buy them to cancel them, but they like to know that, hey, what are my options if this happens?
Is that hybrid policy the same as like a long-term care rider on a whole life policy or an insurance? What's the difference of the two of those?
That's a great question. They're both hybrids. I would suggest that the true hybrids are the ones that are more long-term care focused. The ones that are riders on life insurance policies, those are, hey, I need life insurance, but I also want to have this rider there just in case. And the true hybrids, like the One Americas, for example, the Asset Care, the Securian products, the Nationwide, they all have products that are specifically, even though they're on a life insurance chassis, it's long-term care first is the focal point. But by the way, if you don't use it, there is a residual.
Gotcha. Cool. Which one of those is more cost effective for a client, or does it depend?
It depends. It depends on what the purpose is, what they're trying to accomplish. I would say the most cost-effective way to buy a long-term care policy for a couple is a hybrid, a joint plan that's a hybrid.
Mm-hmm.
And the reason is because when you buy a long-term care policy and it's on a life insurance chassis, there is a death benefit involved to some capacity. So you're paying for a death benefit. Well, if someone comes to you and says, hey, I don't necessarily need life insurance, but I want level premiums, which you cannot have in a traditional long-term care plan, right? Those premiums will go up. So one of the biggest reasons people buy hybrids is to levelize the premiums, to make sure they're never going up. No surprises.
Mm-hmm.
But when you put it on a joint plan, you're only buying one death benefit. So it reduces, it's most cost effective to do it that way. And then the death benefit, of course, it pays out upon the second death. So it's like a second to die life insurance policy. So both clients have the option to use the care, but if neither one of them ever use it, upon the second death, it blossoms into the death benefit. But it is most cost effective to put it on a joint plan.
Yeah. I will say too, I think a lot of clients just in general think that it's an all or none, like meaning you need to get a long-term care policy that covers all of your long-term care expenses. Okay. And when we build a financial plan, the reality is, if someone goes to long-term care and they're the last to die in their family, that's literally their only expense in the world at that time, right? They've probably sold their house, whatever it is, they're in the long-term care facility. That's what they're paying for. They still have a Social Security benefit coming in. They may have other stuff. So I think that's another thought process with a lot of clients is you don't necessarily have to get a policy that's going to cover 100% of your long-term care costs. You can get a policy that's maybe not quite as expensive, that's kind of hedging and covering a portion of that for them. And I think that makes it a lot more digestible for a lot of people.
It really does. I'm really glad you brought that up, Jeb, because a lot of times, people get a quote for a $9,000 a month long-term care plan for 4 years, for example, and they put that inflation or cost of living adjustment on there, which, by the way, is the most expensive part of owning the policy. All of a sudden, those premiums can start going up like crazy. So if you think about the average cost of a long-term care facility is $9,000 a month, okay, that's what the average cost is. But what are my income sources? What am I doing here? Do I need to insure for $9,000? Do I need to pay premiums for a $9,000 benefit, or can I get away with buying a $6,000 a month policy and just know that I've got a gap somewhere that I'm going to have to fill through other resources? Maybe that's Social Security. I had a lady that worked. She was a school teacher in North Canton, like Platte City or something. This was years ago. I was helping her agent design a plan for her, and she was talking about a $9,000 a month plan back then, but she had a guaranteed pension of $6,000 a month for life. She had no liabilities. She had other assets. So I'm like, why are we buying a $9,000 a month plan when you've got a guaranteed income of $6,000 for life? Why don't we lessen that and you have less premium going out and then use some of that to cover the gap when you get there?
Yep.
And it helped her because she had sufficient funds now, but to pay the premium that it really would have kind of messed with her finances. And you know as well as I do that when people are on retired, most of the time to some capacity they're on a fixed income, right? And so trying to squeeze in a long-term care premium with everything else going on, a lot of times can really create an issue. So yeah, they don't necessarily have to insure for that whole 9,000. Let's figure out what our other assets are and figure out how we can address this. The other thing too, guys, when we talk about we talk about premium payments. Sometimes people say, I don't want to pay premiums forever. I buy a policy today. I don't want to be paying premiums on a long-term care policy when I'm in my 70s or 80s. So there are different ways they can address that. They can do a life pay, they can do a 5 pay, a 10 pay, a 20 pay, and they can even do a single pay. If they just want to write a check and be done with it, and they just know that their long-term care piece is taken care of, they can do that as well. A lot of ways to go about it.
Nice. Well, shifting gears a little bit, our next recording of the podcast, we're going to talk about, wealthy families and what they do a little bit different versus the average investor. And I know, how does life insurance play into that role with, wealthy families, wealthy investors versus the average investor?
Life insurance is huge. I've always been a big believer in it for a lot of reasons. I'm probably overinsured. For your younger folks that are just starting out, term insurance is normally the route that they want to go. You know, they're raising a family, they need insurance, they've got a big need, but they maybe don't have the income that they need right now to support a big premium payment. So just get the amount in force that you can. I tell folks all the time, especially when you're young, and this goes back to my protecting your insurability comment earlier, is when you're young, don't buy how much insurance you need or you think you need. Buy how much you can afford, because you're never getting any healthier and the premiums are never getting less expensive. So, when I first started in the business, I always wanted to help people get some of that permanent insurance in force so that they would definitely have, final expenses taken care of and things like that. And my old man always used to say, he was in the business with me as well and a partner over the years. And he would say, Aaron, make them a client first. You can always fine tune it later. Coming home from the funeral, nobody cares what kind of insurance you had. They just want to know that the premiums were paid and it was in force. And so I'd say addressing that is paramount. But then there's also a lot of other I always ask people, what's the purpose? What are we trying to accomplish? Because term insurance is a great answer for a lot of people. Sometimes permanent insurance is a good solution as well, especially if you're doing estate planning. If you're wealthy clients that are definitely going to have an estate tax problem, life insurance is the only way to get Uncle Sam out of your legacy. And wealthy people, believe it or not, people who are wealthy are buying life insurance, even though they may, according to most people, not need it. People are buying it.
Mm-hmm. Well, there's a lot of tax benefits there too, right? So for people that overfund, and we go through that, and I've done it a number of times, and I'll say that we probably don't talk about it as much as we should with some of our clients. But to your point of Uncle Sam being in your pocket, there's two, like with life insurance, two things. Number one, the death benefit always pays tax free. But number two is you can also create tax-free income streams for yourself. If you have a lot of extra income that you wanted to throw at something, that you wanted to be safe, that you wanted to be, maybe act a little bit differently than the rest of your investments, you could always look at that, overfunded life insurance policy, whether that's a whole life, a fixed or a variable, whatever it is. I'm assuming you guys see a lot of that as well.
We do. And again, this goes back to the high wage earners, the people that are creating a significant wealth. They get capped out with their options. When you reach a certain income level, you can no longer participate in a Roth IRA, right? You can only put so much money into a qualified plan. So what are these people doing that have all this wealth? Well, what they're doing is they figured out a way in the tax code. They learned years ago that, hey, if you take money out of a life insurance in the form of a loan, it's not deemed as earned passive or portfolio income, therefore it's non-taxable. In fact, also, you don't even have to do it in the form of a loan. In life insurance, withdrawals are treated as FIFO tax treatment, which is first in, first out. So the first money in, which is your cost basis, is the first money out, which is not taxable. So you can take loans up to your basis and then switch it over, withdrawals up to your basis and then switch it over to loans. But the whole concept is, and you hear people saying all the time, life insurance is a terrible investment. Well, you're right. It's not an investment to begin with. It's actually an asset class. But what we can do is, there's two approaches. The front door approach, which is, hey, Jeb, I need $1 million of life insurance. Sell it to me for as low cost as possible, right? That's the front door approach. I need X amount of insurance, but I want to pay very little for it. Well, when you're using the tax code to your benefit and trying to capture this tax favored growth inside of your policy and tax favored withdrawals, and of course the tax-free death benefit, what if we just shrink the death benefit down? Instead of saying, how much does it cost me to buy $1 million of life insurance? What if I said, I want to put $100,000 into a policy over a period of years. What's the minimum amount of insurance I can buy and stay in compliance with the tax code so that when I start taking loans out, I don't have what's called the modified endowment contract, meaning that the growth inside my policy is now taxable. Mm-hmm. And people are doing that all day long. Mm-hmm. It's a Roth IRA on steroids, because you can now say, okay, here's how much I want to put in. What's the minimum amount of insurance I have to buy? And the reason we're doing that, we're shrinking down the death benefit, is because when you do that, you can manage the internal cost to be somewhere to around 1 to 1.5% over the life of the policy, which is huge.
Mm-hmm. Mm-hmm. That's awesome. Well, hey, I know we're coming up on we're just over our kind of cutoff time frame, but I think these are conversations that we could probably talk all day about because I think they're super relevant to our client base. So it might be worthy of having you on another time, because I think we spent a lot of time on long-term care today. We could probably spend some more time on disability insurance. We could spend some more time on life insurance. So maybe, in the coming months we can do that, but certainly appreciate you coming on. And I know, I guess for our clients to know, like when we work with you, Aaron, OCI is the broker. And so you don't work necessarily directly with our clients, but you're kind of our back office support, if you will, when it comes to us doing life insurance policies, and also can help us really with plan design and stuff like that. So, would there be an instance where one of our clients would need to reach out directly to OCI, or do you want to give them your contact information?
Yeah, I'm local. I'm here in Kansas City. OCI is actually out of Omaha, Nebraska, but I'm remote and I'm here in Kansas City. My direct line is 913-568-2040. And I'm just your educational hub, guys. I am your back office support. Obviously, you can, anytime your client has a need, I can help you with your case design and making sure that we have the right company. I'm a broker, so I do represent multiple carriers. But yeah, case design, product knowledge, that's what I'm here for, is just to be a resource to your clients and and help them address these needs. Again, yeah, I'd be happy to come back and talk about any line of insurance that you guys would like. It's great to be back with you guys, and I certainly appreciate the time today.
You bet. Well, thanks for being on, and it's been productive. And this is Metcalf Money Moment podcast signing off.
Thanks for tuning in to Metcalf Money Moment, the podcast. We hope today's episode provided valuable insights to help you unlock financial clarity, confidence, and peace of mind. For more expert advice and resources, visit metcalfpartners.com. Until next time, make every money moment count.
Jeb Graham, Ethan Hutchison, and Eric Wymore are registered representatives with and securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through WCG Wealth Advisors, a registered investment advisor. WCG Wealth Advisors and Metcalf Partners Wealth Management are separate entities from LPL Financial. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly.